When you think about any business, big or small, say Sarah's Sustainable Smoothie Shop, what's its absolute lifeblood? It's not just those, impressive profit figures you see on paper.
Right.
No, what truly keeps the doors open, suppliers paid, ingredients stocked, it's the actual cash, the cash flowing in and out.
It really is the heartbeat, isn't it?
Yeah.
It dictates if a business thrives or sometimes just survives.
Exactly. And today we're diving deep into working capital management. This isn't just some accounting term.
No, definitely not.
It's the critical financial art, really, that determines if a business can cover its immediate bills, buy new stock, and just keep the whole operation humming.
And to help us navigate these, well, often complex financial currents, we've drawn from a rich collection of detailed financial management insights and practical examples.
So like expert guides for us.
Pretty much, yeah.
Yeah.
Illuminating what can sometimes feel like a dense financial landscape.
Okay. So our mission today, extract the most potent nuggets of knowledge. Reveal not just how working capital operates, but why its meticulous management directly impacts success and, maybe crucially, the ability to grow without crashing.
Let's get into it.
Right. So let's unpack this. What exactly is working capital, fundamentally?
At its core, it's the net difference between a business's current assets, things like cash, inventory, money owed by customers.
Like the ingredients in Sarah's fridge or what the local cafes owe her.
Exactly. And its current liabilities, those are the short-term debts needing payment within about a year.
Her rent, the bill for yesterday's berries, that sort of thing.
Precisely. And what's really fascinating, I think, is that financial managers often spend more than half their time just managing this specific area.
Wow, over half.
Yeah. And it makes sense why. Because healthy net working capital is the #1 indicator of a business's immediate financial health. Its capacity to meet those short-term obligations.
So it's like a pulse check on its financial soundness.
That's a great way to put it. A financial pulse check.
And it all cycles back to something called the cash cycle, right?
Mm-hmm.
Picture Sarah at her shop. Cash goes out for fruit inventory.
Right.
She sells smoothies, converts inventory. Customers or cafes owe her money debtors.
Yep.
And finally, that money comes back as cash. And the quicker she completes that cycle.
The more efficient and, typically, the more successful her business will be. Speed is key.
But if it's that critical, why is it often so challenging to manage? What makes it hard?
Well, that speed is crucial, but there's an inherent unpredictability. Cash outlays for liabilities. Relatively predictable. Sarah knows when rent is due.
Okay.
But cash inflows. From converting inventory and debtors back to cash, much harder to precisely foresee.
Right. You don't know exactly when every customer will pay?
Exactly. And that unpredictability is precisely why it demands such careful, constant management.
And if those inflows are too erratic, a business can hit that liquidity trap.
Yes, the danger zone.
And the real insight isn't just what it is, but that a healthy balance sheet today doesn't guarantee you avoid a cash crunch tomorrow.
Absolutely. It's about the flow, not just the snapshot.
It's the speed and predictability of cash inflows that dictate survival, which is why Sarah needs, significantly more current assets than current liabilities.
A cushion.
Yeah, that vital cushion to ensure she can always buy fruit, pay staff, even if a few invoices are delayed.
Okay, so with all this careful management, what are we ultimately trying to achieve? What's the goal?
The primary objective, according to our sources, is ensuring a smooth operating cycle.
Makes sense.
And you know what that leads to directly? Improved earnings, profitability. It's not just about staying afloat.
No, it's about thriving. And connecting this to the bigger picture, a smooth cycle has benefits beyond the balance sheet. It reduces the risk of damaging relationships.
With stakeholders, yeah.
Exactly. Imagine Sarah runs out of cash to pay her organic fruit suppliers. That loss of trust. It could lead them to revoke favorable terms, demand cash up front, causing a serious ripple effect.
Reputation is everything, especially for small business. So, zooming in, what are the nuts and bolts? What does she need to do daily to keep that cycle smooth?
Well, it means having adequate cash on hand, obviously. Making sure you have enough raw materials, like Sarah always having berries for her top smoothie.
Right. No shortages.
Ensuring all production requirements are met, selling finished goods quickly, having proper collection methods for receivables.
Getting that money in from the cafes.
And, of course, paying your own short-term creditors on time, keeping everyone happy.
Okay. Now, beyond just smooth operations, there's a secondary objective, optimizing the level of working capital.
Ah, the balancing act.
Finding that fine balance between returns generated and exposure to risk. And as you said, those unpredictable inflows make this tricky.
It's very tricky. Think Goldilocks, right? Not too much, not too little.
Just
Exactly. Too much working capital might mean high interest costs. Maybe Sarah bought too much inventory on credit that isn't selling.
her freezer's overflowing with something nobody wants anymore.
Precisely. But too little working capital. That means high risk, inventory shortages, lost customers,
Liquidity problems. Can't pay the bills.
leading to an inability to settle those short-term debts. It's a dangerous place to be.
Which brings us neatly to the third objective, minimizing the interest rate, or the cost of capital, to boost profits.
Right. And this involves a crucial concept, matching the maturity of your financing sources with the assets they finance.
So long-term funds for long-term things, short-term for short-term.
You got it. Long-term funds for, say, a new building for Sarah's second shop. Short-term funds for her weekly fruit orders.
Misaligning those, square peg, round hole.
Creates significant financial strain, absolutely.
And the final objective.
Obtaining an optimal return on those current assets that's higher than the cost of the capital used to finance them.
Making your money work harder for you.
Fundamentally, yes. Ensuring every dollar invested in working capital earns its keep.
Okay, so with all these objectives and balancing acts, how does a business, or how do we measure its working capital health? What's the metric?
The go-to is the working capital ratio, often called the current ratio, current assets divided by current liabilities.
Right. And generally, higher assets compared to liabilities means lower risk of technical insolvency, lower risk of not paying immediate debts.
That's the general idea, yes. Lower risk on paper.
But there's always a but, isn't there? Is there a downside to having too much working capital if a higher ratio is safer?
This is where it gets really interesting. Because while a higher ratio often means lower risk, it can actually lead to lower profitability.
How so?
It's that classic investment principle. Higher risk, higher potential reward. So lower risk often implies lower potential reward.
Okay.
For instance, a very high current ratio, maybe 6-to-1, because Sarah has tons of exotic fruit inventory.
That isn't so.
Right. It protects against insolvency, sure.
Yeah.
But if that inventory isn't moving, it drains profits.
Wow.
Storage costs, spoilage, capital tied up.
Got it. And conversely, a low ratio, say 1.2 to 1.
Seems riskier for insolvency, right?
Yeah.
But it could also indicate very high inventory turnover.
Yeah.
Things are flying off the shelves, which means high profitability. It really is a tightrope walk.
And speaking of tightropes, a major pitfall, over-trading.
A classic mistake.
Growing too fast, basically, and hurting your net working capital. It sounds counterintuitive.
It does, but it happens. Rapid growth can ironically deplete your cash. Imagine Sarah opening 3 new shops in a month without fully mapping her cash flow.
Risky. How does it typically unfold?
Often, a business takes on more inventory on credit, hoping for rapid sales growth,
Okay.
but then struggles to actually sell it quickly or, crucially, struggles to collect the cash from debtors in time.
Ah, the collection part again.
And the negative effect gets much worse. When the debtor's collection period, how long cafes take to pay Sarah, is longer than the creditor's settlement period, how quickly she has to pay her suppliers.
So cash is going out faster than it's coming in, even if sales look good.
Precisely. We see a great example comparing constant sales versus increasing sales scenarios.
What does that show?
Even with rapidly increasing sales and higher net profit on paper, the bank balance can end up totally depleted in that increasing sales situation.
Why? Just the timing difference.
Exactly. Cash inflows from debtors might come after 60 days, but cash outflows to creditors happen after only 30 days. It's a severe cash flow squeeze, even when the P&L looks great.
That's a crucial lesson.
It really is. Undertaking more credit to buy inventory, even if turnover and profit increase, adds major risk if cash isn't generated promptly.
So the rule is, only take on debt if you can settle it on time.
And ideally, have a shorter debtor's collection period than your creditor's settlement period. That's key for positive cash flow. Sarah needs cafe cash before the fruit bill is due.
Now, in the real world, debtor collection, it's not always rigid, is it? Payments don't always hit on the exact policy date.
Not at all.
Yeah.
People pay when they can, when they remember, sometimes when they're reminded. Life happens.
Yeah.
Which is exactly why it's so wise to set up a detailed schedule of expected receipts from debtors and also payments to creditors before you even create your main cash flow budget.
Plan for the variations.
Anticipate and plan, yes. It's proactive.
Our sources give that Longile Limited example.
Ah, yes, a good one.
It shows perfectly how a month sales figure doesn't just become cash instantly.
Right. It gets staggered.
It breaks down into receipts over multiple subsequent months,
Yeah.
maybe 70% the first month after sale, 20% the second, 7% the third.
And then unfortunately, maybe 3% is just irrecoverable. Bad debt.
It really highlights the complexity. You absolutely have to forecast those inflows carefully. Sarah can't just assume all invoices are paid on day 30.
No, she needs to forecast that staggered reality. It's essential for planning.
Okay, so all this talk of cash flow, managing assets, it brings us to another critical piece. The true cost of money. Interest.
Right. If Sarah's smoothie shop can't fund all its working capital from revenue or profits, it needs debt.
And debt means interest.
Absolutely. In South Africa, the benchmark is often the prime overdraft rate. That's typically linked to the repo rate set by the Reserve Bank.
And the repo rate, that's what the SRB uses to manage the economy, right? Curb inflation or boost growth.
Exactly. They lend to commercial banks at the repo rate, and the banks lend to businesses and individuals at prime or above, making their profit on that difference, that spread.
It's interesting, though, why are business loans often so much more expensive than, say, a mortgage?
It really boils down to risk, doesn't it?
How so?
Well, a bank can repossess a house if you default. There's a tangible asset there.
Okay, collateral.
But if a new product, or even Sarah's new smoothie flavor, fails, there's often very little tangible asset for the bank to recover.
So higher risk for the bank.
Translates directly into higher interest rates for the business. It's risk pricing.
This brings us to something that often trips people up. Nominal versus effective interest rates.
Oh, absolutely. A crucial distinction.
We know compounding means interest, earning interest. But you're saying for businesses, it's not just that it compounds, but how often.
Precisely. And investors, or businesses looking at investments, should always base decisions on the effective rate.
Why the effective rate?
Because that's the true annual interest rate earned or paid once you account for those compounding periods within the year.
Okay, let's make that concrete. Say a 12% nominal rate, but it's compounded monthly.
Right, so that means you're actually getting 1% interest applied each month.
Not 12% at the end of the year.
Correct. So if you start with R1000, after 1 month it's R1010. Keep that going. By the end of the year, it's actually R1126.83.
Which is more than the R1120 you'd get if it was just compounded annually at 12%.
Significantly more. That compounding frequency really impacts the final value. You have to look beyond the headline nominal rate.
So it's kind of deceptive sometimes.
Well, let's say institutions might strategically choose which rate to highlight. Our sources point out they often quote the higher effective rates when marketing investments
Makes the return look better.
and the lower nominal rates when offering loans.
Makes the cost seem lower.
Exactly, which is why the effective annual rate, the EAR formula, is so important. It cuts through that confusion.
It gives you the true annual cost or return for comparison.
Apples to apples, essential.
This leads us to one more key concept, the annual percentage rate, or APR.
Yes, APR.
How does that differ from EAR? It sounds similar.
Think of APR as basically the effective rate, but crucially, it's adjusted for loan-specific costs, fees, charges.
Ah, so it includes things beyond just the interest.
Yes. Its purpose is to calculate the total cost of borrowing, the all-in picture.
So it should make comparing loans easier.
That's the intention, absolutely, for individuals and businesses. Logically, the lower the APR, the better the deal for the borrower.
And you often see it with credit cards, right? Where fees add up.
Very common there, yes, because various fees can significantly increase the overall cost beyond just the stated interest rate.
So the APR is likely to be different, probably higher, than the advertised quoted rate.
Almost always, yes, if there are extra costs involved.
And how is it calculated generally?
Generally, you add any once-off costs, like initiation fees, to the loan principal. Then you figure out the monthly payments based on the loan's effective interest rate.
Okay.
And then the tricky part, you determine the interest rate that would need to apply only to the original face amount of the loan to result in those same monthly payments. That rate is your APR. It reflects the impact of the extra costs.
Sounds complicated, but important to understand.
It is. Our sources give a practical example with Letsima Furnishers buying a delivery vehicle.
Right. What was the scenario?
Details the purchase price, the deposit paid, the loan term, the monthly installments, and critically, the initiation cost charged for setting up the loan.
Okay, so those extra fees.
Exactly. And here's the kicker.
Go on.
Even with a quoted nominal rate of 15%.
Which sounds straightforward.
Because of those initiation costs, The actual APR payable by Letsema Furnitures ends up being higher, 15.49% in this specific example.
Wow, so nearly 0.5% higher just because of fees.
Precisely. It's the aha moment. Advertised rates aren't always the full story. You absolutely have to dig into the true cost, the APR.
What a journey indeed. We've gone from the basics of working capital, its objectives,
The smooth operating cycle.
to the dangers of overtrading, the details of debtor collection schedules,
The timing, the forecasting.
and finally peeling back the layers on interest rates. Nominal, effective, and that all-important APR.
And understanding these concepts, well, it lets you, the listener, move beyond just looking at profit margins on a piece of paper.
Right, it gives you a holistic view.
A holistic view of a business's actual financial health, its trajectory. Knowing not just what the numbers are, but why they matter and what they truly mean for cash flow, for sustainability.
So the ultimate takeaway, profit is maybe the story on paper.
But cash flow is the beating heart. Understand its rhythm, manage it well, and you can navigate almost any financial storm.
A powerful thought to end on. So as you go about your week, maybe think about your own finances or the businesses you interact with, Sarah's smoothie shop perhaps. How might these principles, the cash cycle speed, that risk-reward balance, the true cost of money be subtly influencing their success, or even your own choices, in ways you hadn't really considered before this deep dive? Something to mull over.